Hello, everyone, and welcome to Trading with Larry. I am Clint Brewer, one of Larry's analysts. You might even say top analyst, given that Eric and Thomas are not here to be able to defend themselves. As you can see, I will be coming to you solo today. Both Larry and Eric are out, but we wanted to have the show nonetheless to get you ready for the day ahead and talk about some of the things that are happening here in the market this week. So I thought what I would do is just run through some of the events happening overnight, discuss the government shutdown that recently started and how that could impact the market. And then I thought what I would do today is run through some charts, some recent trades that we've done, some things that we're watching, things that you'll see us write about pretty often in Larry's e-letter, Trading with Larry Benedict. If you got to opportunistictrader.com, you can sign up for that e-letter. I'll walk through some of the things that we've been writing about recently and how we're breaking down charts and looking at things. And so we'll walk through a lot of examples. But first, just to start off with some of the news coming in overnight, it's more of the same when it comes to the AI bubble. I'm sure Larry would have a lot to say about this morning. But OpenAI doing another share sale, and this one now values the company at $500 billion. So Sam Altman's OpenAI did a share sale valued at $500 billion. That makes it the most highly valued private company startup in the world. So that's driving chip stocks. You've seen a very positive reaction in semiconductor stocks overseas in Europe and in South Korea. Looks to be more the same here in the U.S. this morning. I just did a quick glance at futures, and it looks like we're set for gains again. And so that's the main news overnight that, again, linked to the AI trade, the AI bubble, so to speak. I will go more into what can make that bubble burst here in just a moment. But that's the driver overnight. And, one other thing you can see is that the stock market is just completely yawning at this whole government shutdown news, which when you look back historically, that's pretty much what you tend to see. So I think, since 1990, we've had about 6 other government shutdowns. The last one happened in 2018. The one that happened in 2018 was actually the longest one on record. I was looking at shutdowns that went back to the 1970s, and the one 2018 lasted, I wrote it down, I think it's about 34 days, which the average shutdown, when you look back, it lasts about 8 days. So these don't tend to persist for that long. A major reason why is that both sides of the aisle would want to come together to find a funding solution for the fiscal year, because it's estimated that a shutdown with the potentially hundreds of thousands of furloughed workers, that's going to cost the economy about $1 billion a week. That's the number you frequently see thrown around. So they don't want to let this last too long. The market doesn't expect it to last too long. Because when you look back historically, the market mostly yawns at this. When you look back, the S&P 500 ends with during the duration of the shutdown, it's up about 55% of the time, down about 45% of the time. And on average, it ekes out just a very, very small gain of like 0.1%. So again, you look back historically, and the shutdown, while it's going to be all over the headlines, it tends to not be a huge event for the market. It's worth maybe paying attention to this time around a little bit more carefully, because both sides do look dug in. Maybe we do see a little bit of a longer shutdown episode persist. So we'll see what that means. The other big thing that happens with the shutdown is that various government agencies that might be reporting economic data are no longer doing releases. So for as long as this persists, the next big piece of news we have coming up would have been the non-farm payrolls report coming out on Friday. And this takes on more urgency, a bigger sense of importance, because of where the labor market is right now, some of the deterioration we've seen, where inflation is still out running pretty high. And so it's putting the Fed in a really tight spot. And we'll talk about that more here in just a moment as well. So those are the big things continuing to drive the market overnight. Again, it looks like, but for now, the markets are shrugging off the shutdown. They're focused more on this open AI valuation news, and the bubble persists here. And so what is it going to take to finally cause a reversal in some of these AI names that are just going absolutely parabolic. And I would say a really high level, you need to follow what the Fed's doing and what the expectations for the Fed are, because again, they're in a tight spot right now. So they're facing this prospect of a weak labor market, but inflation staying high as well. And so that presents that stagflation scenario. Now, recently, they have been really fixated on the labor market side of things. So that happened with Jerome Powell's speech back at Jackson Hole, where he made that pivot away from inflation toward the labor market that locked in expectations for rate cuts. Investors are hoping that there's a lot more ahead. They've had to temper those expectations a little bit. So that's that looser monetary policy, those rate cuts, that can be fuel for the rally, especially when financial conditions are already running pretty loose. And so that's fuel for the bubble. But the thing you need to keep an eye on is how expectations for rate cuts are evolving, because they shot through the roof when the Fed cut last month at their last meeting. But they're coming in some because the Fed, they're really I don't know if they're intentionally trying to cause confusion, but they're causing a lot of confusion because they're wavering on these mandates right now. So in a speech last week, so this, after Jackson Hole, Powell's out saying that there's no risk-free path. So he's basically saying no matter what we do, we're going to make one side of the mandate worse. We can cut interest rates to try to help the labor market, but that is going to could hit inflation higher. Or we decide to focus on inflation by keeping rates high, but we're going to make the labor market worse. So that's the scenario they're in right now. And you can see just across the market various measures of how the labor market's doing, how inflation's doing. That's the stark choice the Fed is facing right now. And so what complicates matters for them, again, is that this shutdown, so long as it persists, they will not be receiving government reports. But that doesn't mean they're completely flying blind. We're getting reports from private companies. And we've had a couple this week. One was the ADP report on private payrolls that came out just the other day. And again, we're seeing this trend of a weaker labor market. So ADP showed a loss of 32,000 jobs in September. That compared to estimates for a small gain at 45,000 jobs. So a loss of 32. And then here's the other thing is you continue to see across various reports these negative revisions. So the BLS that does the payrolls report, they caused a stir a couple weeks ago when they came out and did their annual revision to payrolls. They revised in the 12 months to March, the number lower by, I think it was 911,000 jobs, which that was the largest negative revision on record. We'd seen prior months payrolls getting revised lower as well. It brought a 3-month average down to the lowest since the pandemic. And now we're continuing to see this trend because ADP, their August figure got revised from a gain of 54,000 to a loss of 3,000. And so we're continuing to see that trend of weak labor market data. We saw that in the ISM. They came out with their report on manufacturing sector activity. When you see that report will get thrown around a decent bit in the media and the press, and you'll see an above 50 or below 50 number reported. That's how these things are structured, so that a reading above 50 that points to expanding activity in the manufacturing sector, below 50 points to shrinking activity. And there's the headline number, but what you want to pay attention to is all these underlying components that go into the headline number. And so the employment number, the employment figure for that manufacturing survey came in at 45. Remember, below 50 is contracting, so it came in at 45, but the prices paid came in as almost 62. All right. So again, here's that stagflation scenario. You've got the prices pay, which is an inflation indicator. It's what these manufacturing firms are paying for inputs, is at 62. You've got employment at 45. So that's the dilemma for the Fed right now. The market is expecting the Fed to lean into the labor side of the equation. So I want to share, if I can, share my screen here really quick and show you where estimates are coming in when we talk about these things. And so, wait for this to pull up. See if it'll get off the Tesla screen here. All right, there we go. Okay, so when we talk about what the market is pricing in, I just want to show you where you can go if you ever want to look into this and follow along. This is the CME. If you look up the Fed Watch tool from the CME, you'll be directed to this site, and you can look at where various Fed meetings. So it's got the various Fed meeting dates plotted across the top. So you can look at each date. So coming up, they have a meeting at the end of October. And again, this is taking on some increased importance because the Fed's not going to be receiving several reports that they would otherwise be watching. But what you can see is the current rate, since they cut by a quarter point, that brought the range of the Fed funds down to 4% to 4.25%. Okay. And right now, the expectation for their October meeting is that there's only a 1.1% chance it stays at that level. And there is a 99% chance that it's going to get dropped by another quarter point to a range now of 3.75% to 4%. So the market's anticipating very high probability of another cut coming up there. And so that's one thing to watch and keep an eye on. You can go out to that site and track those probabilities. You can also look at how that's evolving in the months ahead. So right now, if you were to go through those probabilities, you would see the Fed is expected to cut rates by about 4 times over the next 12 months or so. So that's just that's what you want to watch. You want to watch if that expectation for 4 cuts, if that starts to come in and go the other way, because then here's the other thing that the Fed is dealing with right now, and that's on the inflation side. So this is a report the Fed did receive just before the government shut down, and this is their preferred inflation gauge. So I want to share this chart. This shows the year-over-year change in the core PCE index. So personal consumption expenditures, mouthful to say, it's a PCE index. Why is this important? Is because this is the Fed's preferred inflation gauge, and this excludes food and energy. So this is the core index. And exclude food and energy to get a better look at underlying inflation trends. Now, I took this back, the full series, so you can just see how the rate of change, the year-over-year change in this PCE index has evolved. But if we zoom into a more recent period, this is the problem for the Fed. You had inflation kind of in this Goldilocks zone for the longest time. 20 years just bouncing between 1% and 2% pretty much. The Fed's inflation target's 2%. Well, now you had this big inflation wave in the mid-2022 that took core PCE up toward looks like topped out around 5.6%. And we've had this disinflation trend, which has allowed the Fed to start to cut because inflation, while it's still rising, it's coming in. But look at this, how this is stalled out. This is really since June 2024 has just been moving sideways, stalling out around this 3% level, which is well above the Fed's 2% target and well above where inflation had been. So this is why inflation is such a big headache for the Fed right now. It's because that disinflation trend has stalled out. The last, I think, 3 months or so, you've actually seen that core PCE number rising. The last 3 or 4 months, you've seen it rising. So that's why this is such a challenging environment for the Fed right here. So that's one thing to keep an eye on. Especially as we get some more data releases. If the government stays shut down, pay attention to some of these like ADP, ISM, because maybe that'll carry a little bit more increased importance for how things impact the Fed. All right, so one thing now, what I want to walk through next is just some of the some recent trades that we've done, just things that we're looking at, things that we track across what Larry is trading, stocks and ETFs that we like to look at and trade. And so I'm going to start actually with Tesla. So Tesla seems to always be in the headlines. I think there's a headline last night that Musk, I want to say he became the first person to top $500 billion in net worth and personal wealth. So congratulations, Elon, on that feat. So let's take a look at Tesla stock and what was helping to drive that for him for sure. And we did a trade on this here recently. So the one thing we were tracking, and again, we were writing about this in the e-letter a couple months ago, but the thing we were tracking with Tesla was this symmetrical triangle pattern and the breakout that you had from this pattern. Now, what Larry will do a lot of times is he will look at the prevailing trend, which in this case you had this breakout, and you start to see higher highs, a higher low, a higher high. Okay, so now we've got that uptrend in place. We want to look for a spot to a pullback to get into that uptrend. And here's another thing. Look, if you're just starting out trading, it really helps to focus on one stock. Focus on one stock, or an ETF, and learn its characteristics. Because here's one thing in our study of Tesla, a key characteristic that we notice with the stock is that it likes to have these big, it likes to do reversals when you have a big single day move in one direction. So if you have an outsized move, a daily move lower, the stock has a tendency to want to reverse higher the next day and vice versa. And so what we were watching with Tesla is we had, coming in, I think this was the second, coming into the second, we had this really big down day, this down bar right here. This was an outsized move lower that brought Tesla right back to the 50-day moving average. That's a blue line. So that's an important support level. This counter trend reversal move in this overall uptrend off a big down day. So that's what we want to look for, the reversal off of that. And that's what we had. So you see the test of the 50-day, stock move higher. Right around this area, we added calls on Tesla, and I think we had about a 38% gain in 6 days or so, just trading around that event. So that's one thing to watch with Tesla. Now, with Tesla, what I would keep an eye on for here, I don't see a lot developing right now, but you're coming up. Price has had this nice move, and you're coming up to this prior high. So if the stock, if it's looking extended, this would be a logical spot for the stock to pull back and maybe start a new consolidation pattern. So that's something to keep an eye on for Tesla right here. Another one I want to go to is with gold. So I'm going to just punch in. We'll do the ETF with GLD, and I want to highlight how the RSI, we talk about the RSI a lot in Larry's e-letter and a lot of the reports we send out to subscribers. And one thing that we'll highlight often is that, RSI, it's frequently used, it can really be used two ways. One is to, you get the extremely high or low readings, a lot of times 30, below 30 is oversold, above 70 is overbought. You can look for divergences. I'll show you an example of that here in just a second. But one thing with RSI is that the overbought and oversold zones can shift depending on the trend that you're in. So when you're in a strong uptrend, instead of 30 being oversold, a lot of times you won't see the RSI dip below 40. So 40 can end up being an oversold level, and gold is a great example of this. I mean, gold has just been on an absolute tear. I know we've talked about this from time to time on the show. But when you see gold, I mean, this goes back to the start of 2025. When you see gold in this strong uptrend, and you come down here to this RSI panel, just look at this. Anytime gold had a pullback, the RSI could not get below that 40 level. So 40 serving as an oversold level on the pullback. Sometimes these tests of 40 coincided with a test of the 50-day. So if you're looking to trade a counter trend move with a stock that's in an uptrend, that's one way you can use the RSI and moving average support, so to speak, is that you look for these. If it's an uptrend, you look for the oversold level down to 40, and you look at that if that oversold move is lining up with a test either of a key moving average like the 50-day or a test of price support. So back here, here's one you could have spotted. You had the dip to 40 on a pullback, but GLD held support at that 300 level. So that was a good area to maybe watch then for the counter trend move higher back in the direction of the prevailing trend into that. So we talked about that a lot again in the e-letter. We talked about how to use combine things like the RSI with moving averages, or what the RSI is doing in conjunction with price. And so that's just a couple examples of what you can keep an eye on there. There's one more, or actually two more, I wanted to walk through really quick in terms of how you can use. Now, this is going to be more of an example on, call it intermarket analysis. So Larry does a lot of this. He does a lot of intermarket analysis. He is looking at how one market is moving in relation to another, because it can really it can either tip off a pending reversal or confirm trends that are in place. So a really common example would be, let's go back to gold for example. A common example there would be how the dollar's movements impacts gold. Gold's just been on an absolute tear this year. Well, the dollar is off to one of its worst starts ever. The dollar's down. I think it was down 10% at one point through September. And you go back to the 1970s, and this ranks as pretty much one of the worst year-to-date returns for gold, or for the dollar ever. But a weaker dollar tends to boost gold prices. So that's one example of how you can use what's happening in the dollar to confirm what could be happening in a market like gold or other commodities. So one thing to watch for is if we do see the dollar start to find some support and turn higher here and start to strengthen, that can mark a top, near-term top in gold. So that's one way to use intermarket analysis. Another one to keep an eye on, especially how it's unfolded this year. I'm going to share my screen. I'm actually going to get the ticker pulled up really quick. One to keep an eye on, especially with how it's evolved this year, is with Bitcoin. And once I get this pulled up, I will share my screen. All right, so here is Bitcoin. And again, I want to stick on the theme of intermarket analysis and using Bitcoin to confirm what's happening in the S&P 500 and the NASDAQ. And so you've had several instances of this year. Earlier in the year, look, Bitcoin peaked in December, came back to test that peak in January and rolled over from there, lost the 50-day moving average support. While the market, the S&P 500, heading into that sell-off in April, the S&P 500 peaked, I think it was right there. I think it was on February 19th. So, Bitcoin had peaked, tested its peak, and rolled over about a month before the S&P 500. So that's one way Bitcoin tipped, this shifting sentiment among investors to this risk-off kind of view, which showed up, a lot of times that shows up in cryptocurrencies before it shows up in the market. Now, Bitcoin helped flag the bottom too. So Bitcoin, here's that's March 11th. When we know the market, the S&P plunged to new lows in early April. Bitcoin, here's April 7th, April 8th, April 9th. Bitcoin barely undercut this prior low. So that was a sign of strength coming from Bitcoin, and then the rally there back above the 50-day. So that was Bitcoin again hinting at a directional change of trend in the S&P 500. And so now we come back to what's happening recently. And this is where the price action in Bitcoin has been a little bit concerning once again, because we had not seen Bitcoin confirming the move higher, especially over the past month in the S&P 500. So this initial peak, this is mid-July. Bitcoin topped out near 120,000. Tested it again in August. In doing so, now here's that negative RSI divergence that I said we talk about. So the RSI made a lower high on that test. So that's another hint that a change of trend could be coming. And then Bitcoin pulled back, and it's chopped around its 50-day moving average a little bit ever since. So this was one thing we were watching, a reason to stay cautious on the market over the last month or so, is because Bitcoin was not confirming those new highs in the S&P. Now it's been firming up here. It came back to test this 110 level, $110,000 level again, and we're bouncing off that. Still not back to new highs. So this is still one to keep an eye on. But again, this is how you can use intermarket analysis to form a view, help inform a view about what you think could happen in the stock market. And so this is one way to use Bitcoin to do that right here. All right, so I'm going to wrap it up here in just a second. One thing I did want to mention: we had some viewers write in yesterday with some really nice positive feedback about the discussion Larry was having on payment for order flow and the billions of dollars that some of these hedge funds, these market making firms are spending to have brokerages send order flow their way, so they get a peek at what is going on. There's two ways they can make money from that. I mean, they can see your trade. They, to the extent they're allowed to do it, or it's legal to do it, they can front run those trades. Or by taking those trades, they can by making markets or collecting the difference between that bid-ask spread. So that's one way. And algorithmic trading is very popular in that space. And we talked about that payment for order flow is one way that algorithms are taking advantage. Well, Larry is going to be hosting an event on October 7th. It's happening at 2 p.m. And he's going to walk through a strategy he uses, that he's been using for decades now, to help get around what the algos are doing. And as part of that, too, we put together a report. We just released this report. It's a special report that walks through really three ways that algorithms are stepping in and taking advantage of the everyday investor, and how they can take advantage or put your portfolio at risk. We talked about payment for order flow being one of those. If you've ever noticed and wondered why waterfall declines in the stock market. So if I would define a waterfall decline as a significant move lower happening in a matter of days. We had a waterfall decline in April around all the trade war headlines. We had we've had one, I would say we had one last August around this whole yen carry trade headlines. 2018's Volmageddon it's another episode. 2010's flash crash, and we've had a host of others in between. Well, if you've wondered why those seem to happen often and come out of nowhere, algorithms are playing a key role in making that worse. We go into the reason why, and there's another way that algos are impacting your portfolio, and it has more to do with traditional money management and how algos are turning the playbook for traditional stock picking on its head. So we go through each one of those areas in this report. And if you go out to, there's a website for it, 12monthsToRetire.com. So it's the number 12monthsToRetire.com. You can get access to that report. It's completely free. So you can see, we get into more detail with what Larry was talking about with payment for order flow, and some of the other things you need to be watching out for with those algorithms. So that will be all for me here today. Larry will be back with Eric on Monday. Just as a reminder, he records his Ask Me Anything for subscribers on Friday. So if you subscribe to any of Larry's products, you will be hearing from him tomorrow. Otherwise, he will be back here on Trading with Larry on Monday along with Eric. That's all for me today. Thanks for tuning in.